Let's talk about stocks and bonds. You've heard the terms a million times, right? They're the absolute building blocks of investing. But what's the real difference? Well, in the next few minutes, we're going to make it super clear, and we're going to start with a simple lemonade stand.
Yeah, that's right. We're not jumping into the chaos of Wall Street just yet. Nope, we're starting right on a neighborhood corner with a problem that's actually pretty easy to understand.
So picture this. There's a lemonade stand that's just crushing it. I mean, the lines are around the block. They can't squeeze lemons fast enough. The founder knows they've got a hit on their hands, but they've totally maxed out. It's time to grow.
That dream of a second location, a lemonade empire, is just one thing away: money. $1,000 to be specific. And that's the classic problem every single growing business faces, from a lemonade stand to a tech giant. How do you get the cash you need to get to the next level?
Well, when you boil it all down, the founder really has two main choices. They can sell a piece of the business itself, give up some ownership, or they can just borrow the money and promise to pay it all back. And these two paths, well, that's the whole difference between stocks and bonds right there.
All right, let's go down path number 1, selling ownership. This is where the founder says, okay, I'll trade you a slice of my company for the cash I need right now.
And that, my friends, is exactly what a stock is. It's not some complicated piece of paper. It's a share of ownership. When you buy a stock, you literally become a part owner of that company. You own a tiny piece of the pie.
So let's go back to our lemonade stand. The founder creates, say, 50 shares in total for the whole company and sells 10 of those shares for $1,000. Now, those new investors, they own 20% of the entire lemonade business. They share in the risk, for sure, but they also get 20% of all the profits. From now on, forever.
But hang on. What if the founder doesn't want to give up a piece of their company? What if they want to keep 100% of the profits for themselves? Well, that's where the second path comes in. It's all about borrowing.
This is bond territory. A bond is basically a fancy IOU. It's a loan. When you buy a bond, you're not an owner, you're a lender. You're playing the role of the bank, lending money to a company or even the government, and in return, they promise to pay you back, plus a little extra for your trouble. So our lemonade entrepreneur could totally go this way. They find an investor willing to lend them the $1,000. In exchange, they issue a bond that says, I promise to pay you back the full amount in 5 years. And as a thank you, I'll pay you 5% interest every single year until then.
Okay, so those are the basics, right? You're either selling a piece of the company or you're taking out a loan. But how do these simple ideas scale up from a little neighborhood stand to the massive global financial markets?
Well, one of the biggest differences you'll see is where this stuff is bought and sold. Stocks trade on big central exchanges you've heard of, like the New York Stock Exchange. Everyone goes to one place. Bonds, though, they're mostly traded over the counter. It's more like a decentralized network where big-time brokers and dealers make deals directly with each other.
So we know what they are, and we know where to find them. But here's the real million-dollar question for any investor. Why would you pick one over the other? And it all, and I mean all, comes down to the classic trade-off between risk and reward. This table just lays it out so perfectly. With stocks, you have equity. You're an owner. The upside is huge. You can earn from the price going up and from dividends. But the risk, also much higher. With bonds, you just own debt. You get these nice, predictable interest payments, so it's lower risk. And here's the key, the absolute kicker. If the company goes bankrupt, the bondholders, the lenders, get paid back first. The stockholders, they're last in line and might get nothing at all.
And to put some numbers on that reward part, historically, the stock market has returned, on average, about 10% a year. That number reflects the massive growth potential you get when you're an owner of successful, growing companies.
Now, on the other hand, the bond market's historical average is closer to 6%. See, it's lower for sure, but it's also a heck of a lot more stable. That really shows you its main job, providing steady, predictable income, not necessarily explosive growth.
And this quote from a certified financial planner just hits the nail on the head. You don't buy bonds because you think they're going to shoot to the moon. You buy them to be the stable, steady anchor in your portfolio that balances out the wild ride of the stock market. And this is why bonds are safer. This priority list is set in stone. If our lemonade stand goes belly up, the law says who gets paid first, and number one in line, the bondholders, the people who loan the money. Only after they're paid in full does anyone else, like the stockholders, the owners, see a dime.
Okay, let's bring all this theory back to what actually matters. You, your money, your financial plan. How do you actually use this information?
And here's why this is so important. The real magic isn't about choosing stocks or bonds. For almost everyone, it's about choosing stocks and bonds. You combine the powerful growth engine of stocks with the stable, defensive anchor of bonds. That's how you build a portfolio that can actually handle the crazy ups and downs of the market.
So how do you figure out the right mix? Well, a really common rule of thumb to get you started is the 100 minus your age rule. It's super simple. Just take 100, subtract your age, and that's a rough percentage you might consider putting into stocks.
And you can see how that plays out over time. When you're 30, you've got decades to grow your money. So you might be aggressive, maybe 70% stocks. But as you get closer to retirement, say at age 60, your goal changes. It's more about protecting what you've built. So you might flip that and have 60% in safer bonds.
So let's wrap it all up. If you remember anything from this, remember this. Stocks mean ownership. You're an owner. That means higher risk, but also higher potential for reward. Bonds mean you're a lender. You made a loan. That's lower risk, and in return you get stable, predictable income.
So there you have it. You now understand the fundamental difference between being an owner and being a lender. The only question left is, when you think about your own goals and how much time you have, what's the right mix of growth and stability for you?
Don't forget to subscribe to the channel, like the video, and click on the bell icon to turn on notifications.